Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 18th, 2018. This video is somewhat of a follow-up to the video I put out earlier today. On that video, we took a look at the long-term charts. Those were 10-year weekly charts on all the major U.S. indices, small caps, large caps, and then drilled down and looked at the bigger picture on some of the top leading stocks, about the top 12 or so top components of the S&P 500 as far as market cap goes and their weighting in that index. Now, what I want to do in this video is just kind of hone it in a little bit more because timing is everything. I can sit there and a lot of long-term charts. I'm expecting a correction or bear market sometimes in 2018. No later than first quarter, first half of 2019. But that's a pretty big window. What do you do with that? What if this market goes on to make go up another 10, 15% before we get that correction. So, I've always said in trading, there's a big difference in my book of being wrong or being early. Being wrong means taking a trade. Let's say it's a short trade. You short it, um, but you get stopped out. The trade goes against you. Your stop is hit. You lose. You book a loss on that trade, and then the trade goes on to play out exactly as you thought. That's wrong. However, being early is you short, market goes up a little or the stock goes up a little, you're well within your stop parameter, and then the trade goes on to play out. That's being early and still being right. So big difference there. I don't want to be wrong. I don't mind being a little early, but let me just get to the point here and show you what I'm looking at now as we kind of focus in on the. I'm going to take a look at the 11 sectors in the S&P 500, and then quickly jump down to the daily time frame. I'm doing this only for paid members of the site, subscribers, and those on a free trial basis, because a couple of these trade ideas that I'm going to go over, or the top components of the S&P 500, may be official trade ideas soon. I think as more I look at these charts, I think we're headed down um, in the coming weeks here. Little work to be done, and we may know as early as next week if these bearish scenarios are going to play out. So let's dive into the charts real quick. We're going to go through again 11 sectors. The S&P 500 is comprised of 11 sectors. They're all in the Spiders ETF. These are the same sectors within the S&P 500. And let's take a look at those charts. XLE, we'll look at just a weekly and a daily time frame. The daily will help us hone down a little bit more. But when you look at XLE, and this has been the big buzz lately, energy stocks, oil flying high, what I see, what stands out to me is this potential divergence as we make this triple top high. We have three. This is the third attempt at that 70-50 level. And certainly we could break out. And it'd actually almost be better to see a little pop above. That would set the stage for a nice bull trap. If we broke out above, you'd have divergence. Now keep in mind, you have negative divergence even as we make an equal high here. With prices making equal highs and the indicators making lower highs, that is negative divergence. But we need to see it confirmed. By confirmed, we need to see a reversal, and we need to see this PPO cross back down over bearish crossover on the PPO. That, in my book at least, gives us confirmed negative divergence, while this is potential negative divergence. Why do I call it potential? Well, because the PPO is and the R side, these are momentum indicators, and they're heading up. And as long as prices continue to rise, which they could, then we go up, and then we take out that previous reaction high, we no longer have divergence. So again, this is just something I call it. I don't know if anyone else out there, refers to it this way, but this is what I call potential divergence. And if it's confirmed soon, then that will set the stage for a considerable correction in energy stocks. I think they'd probably come back in here down to about the 70-ish level. So let's look at it on the daily chart real quick, because this is, it's a decent weighting. I haven't updated these numbers lately. Give or take, it's about 6% of the returns in the S&P 500. There it is. There's that clear triple top. This chart goes back 2 years. So you can see that XLE has struggled with this area. It's reversing off it today after just barely punching through it yesterday. So technically you have that divergence there. Thing is, even if we pop above it, we are extremely overbought. We're overbought, very overbought on the weekly time frame. We're overbought here on the daily time frame. So to me, it's just a matter of if there's any more upside. I think it's very limited. In other words, you're picking up nickels in front of a steamroller if you're long energy stocks now or thinking about going long. That's my opinion. Maybe I'm wrong, or I will. Maybe I'll be proved wrong. There's a little bull flag. It hasn't really played out to its full measured target, but either way, oversold, I'm sorry, yes, overbought, I should say, overbought at resistance. Um, hmm, not the best time to look long. In fact, I'm looking for the next shorting up there. All right, let's just go on to the next sector. XLI. This is about a 10% weighting. This is the I don't know if you can make it out in the video. This is the industrials. Um, One of the components of the S&P 500. This is a daily chart. There's a potential downtrend line you can see here. I have it colored lightly here. I'll turn that up for you to see a little better in the video. So there we are at downtrend line resistance. We did have a divergent low right here. You can see that this is a divergence line with positive divergence on the indicators, and that led for a pop. It played out for a rally. Now the big question is, if we're still in a bull market with a lot more, with new highs to go, if this market's going up another 15, 20, 30+% from here, then you'd expect these daily divergences to play out for a pretty big trade. However, if the tide is starting to shift and this market has topped or is close to a top, and I can tell you this, I didn't go through all the stocks in the S&P 500 in that video earlier, but as I went in the video, I didn't go through earlier yesterday and last night I did go through a lot, and there are quite a few. Walmart, for example, was just down there. So I stopped right before Walmart. I think that's like one of the, number 13 as far as market cap. That one's clearly in a bear market, well off 20% off its highs. And there's quite a few others as well. So we're starting to see some big companies really roll over, and they are in their own bear markets right now. But again, the bulk, when you look at the stock market, it's the sum of its parts. So we can't say the same for the broad markets yet. But there it is. There's XLI at resistance, and the intermediate term trend, since the highs back here in the beginning of the year, is clearly bearish. No matter who you are, bullish or bearish, you cannot argue, because a downtrend is defined simply as prices making a series of lower lows and lower highs, and that's what these arrows show you. The primary trend is still up, even though we've taken out that trend line. When you take a step back at a weekly chart, which we'll do right here, but there it is. There's your primary bull market uptrend line. So again, when you look at this, you can't argue that XLI is not in a bull market. We're not. We had a correction off the high so far, about 13 or so percent, but that doesn't mean that the bull market's over. We've had plenty of corrections along the way. But we have just recently taken out a very well-defined trend line, and this is a key level I'm watching. That's why I'm doing this video for you guys, giving you levels if you want to trade these ETFs. 71.80-ish. Look for a weekly close or a daily. Yeah, this is a weekly candles, weekly chart. So a weekly close below that would most likely do the trick in XLI. And although it won't go there, in a day or a week, and it's not going to be a straight shot down, I see this one going all the way down to 58.64 before all is said and done, before I would look to go long and position for what's either going to be a bear market rally or the end of a correction, even if that correction, quote unquote, is more than 20%, and some will call it a bear market. So um, but we're still talking about an 18% drop in the industrials, and that have a big hit. That would definitely have its impact on the S&P 500. Next one up, and I'm not going through these in any particular order. I will try to talk on the weightings. This one's about 8%. These are consumer staples. We had, this is almost divergence, not quite, because the PPO made a lower low. We do have, I should say, positive divergence here on the RSI. But this was a pretty important support level, and XLP broke below that support level. You can see that reaction there. We can probably see it better here on the weekly chart. So this is the bigger picture. This trend line, I didn't take off the 2009 lows because I can see a better fit with this one, more reactions right here. So this is my preferred trend line. It was breached there, but what stands out to me is that this run in XLP culminated in a divergent high, negative divergence here on the PPO. And right now, staples are not looking good. Look at these momentum indicators pointing straight down. We're close to oversold, but we're not there yet. And again, this is where things start to change. If we are in the early stages of a bear market, just entertain that thought for a second, no matter how bullish you are. I'm not saying that we are yet, because we can't say that yet, at least not definitively. But if we are, you're going to see a change of character. XLP hasn't become oversold, and even back here, it didn't even hit that level. This is really, in some instances, what I'll do is I'm actually looking at this chart. I treat every stock, every index, every ETF differently. just because the 30 level is commonly referred to as the oversold level on the RSI, um, that hasn't been the case because here's the entire bull market, even the bear market lows, and we never hit that level. So you want to put a line here around 34, 35, and that's really your oversold line here on XLP because that is where, as you see, as I go back in time, that's where all the reactions occurred. So I like to be open-minded, not just always go with the, status quo. So technically, it is oversold. And where I was going with this is, if this is a great bull with a lot more to go, this is where you step in and buy. Because if you did that every other time in the past, just follow my circles up, you were treated well. You were rewarded for it. That's the nature of a bull market. You buy pullbacks to support, or you go long on oversold readings because oversold during a bull market, there's two things. Typically, it's very fleeting. You tag those levels in reverse, and you don't come back to it again. Whereas the opposite happens during bear markets. Oversold tends to become more oversold, meaning cross down below that level, or stay oversold for an extended period of time. And if we zoom in, you can see here, we've already done that. We hit that level, had a little bounce, and moved lower. So this is a change of character. And we also took out support here. I was bullish. I did take a shot on some of these stocks. I can't remember. We might have been successful on some or all those trades, or maybe stopped out. I really can't recall. I trade so many stocks, but I thought it was objective there at that level to support. We had divergences, but we took that support out. That is a change of character. This was that $50 level was very well defined. A lot of reactions here, reactions there, and again, the bigger picture is we've broken the entire bull market. That's that bull market trend line breakdown, back test, and we're moving lower. That doesn't look good. There it is on the daily chart again. I already covered that daily chart. XLB, I won't spend too much time. It's only a 3% weighting. These are basic materials, but it is a component of the S&P 500. So I have two alternative trend lines here. This yellow one, which was already broken. Let me move that one out of the way. You can see pretty fairly well defined, not great, but a breakdown, back test, and we're well below that trend. And here's the alternative trend line right there, and we're still below that one as well. Now, I'll play devil's advocate here. For the bullish side, I will say that the PPO 9 EMA, which I like to use as a trend indicator, is still above the zero line. It's been above the zero line since this point, indicating the trend is bullish, and the PPO is curling up. So if this market can rally here off these levels, like I told you, we're, precarious technical levels, but a lot of things are still above support. And as I always say, support is support until and less broken. So there's a chance here that we can continue up, and maybe these turn line breaks, maybe that's all we get out of that correction. Maybe we go on and back test them at a higher level and then roll down. That would actually put in a divergent high or potential here. So, I'm trying to look ahead on these charts, and that's what I see, that any new highs, if it were to happen in the next few months here, you draw a line like this, you would see that these indicators are lagging so bad that any new high, again, if it came within the next few weeks or few months, would almost certainly be a divergent high, and you know set the stage for a much deeper correction in XLB. XLV, healthcare sector, there's a 2009 lows. That was the end of the last bear market. So here's your primary bull market uptrend line, pretty well defined. Only a couple little candlestick wicks, but you captured all the bodies, and the other wicks or shadows or tail. Oh, these are tails down below. Wick when it's above, but they're also shadows on either side. That skinny part. So there it is. A lot of reactions off. First reaction there, another reaction on that flash crash right there back in 2015. A lot of reactions there, and you can see we're hugging this line. We haven't given it up yet. We've been dancing on it. Looks like to me like a sailor thrown overboard, clinging to a lifeboat. Dear life. This thing is just holding on by a thread there. So again, we haven't given up the ghost yet, but if we see a big red weekly close below, we will. That'll be bearish. Bring that trend indicator below, but the bullish case would have another thrust up here, and I'm not going to give it coin toss odds. I'm doing this video because I am telling you right now, I do favor downside breaks. I wouldn't say it's 90%, not even 80%, but it's over 50%. I think we head down in the coming weeks to months. And if it changes, if the charts change and these levels hold and I start to see something else, I'll adapt my analysis. Here's XLT. I've mentioned this a lot in the past. Telecom's been in a sideways trading range for over a year now, this big box here. But this most recent high in the telecom sector right here was a divergent high. So you can see it continues to fail at that level, and the indicators as prices went up made that new high or equal high. The indicators are lagging, putting in negative divergence. So the longer term outlook for XLT, in my opinion, is bearish. XLT is only a 2% weighting in the S&P 500, so really not going to do too much. This one's important. XLF. About a 15% weighting in the S&P 500. Ugly, ugly chart, in my opinion. Quite bearish on the financials, and I would be the probability of the market going to new highs without the financials is very, very low. And if you add in tech, the market is mostly tech and financials, the S&P 500. So here's your uptrend line. I jumped out to a 2-day period, 4-year chart, well-defined uptrend line, breakdown, back test, and that's just ugly, ugly, ugly. I don't see anything good unless financials can regain that level. Back here we had an inverse head and shoulders bottoming pattern that played out well. But here we zoom in, and again, you can see this breakdown back test. We had some positive divergence right here at that recent low, but look what it played out for. See, I'm referring to these divergence lines on the indicators, lower low in price, and it played out for a rally, but so far that rally was only about less than about 8%. And it also took us to back test that trend line from below. There's also resistance there. So the financials need to get up there and regain that trend line and do it with conviction soon and really take out the old highs, or this bearish scenario play out. So look for a break if you're looking to short XLF. I should have a line a little below that. Call it about 2660 to be safe. And you can see, that's one target area down there, about 2254. Again, trend indicators are still above zero here, but you had that negative divergence that indicates that there's probably more downside to come here in financials. A couple more, XLY. Consumer discretionary. You can see I took some liberties here. There's a meltdown in the end of 2009, but this trend line fits really clean right here. Captures some of these reaction lows back there. Almost gets that one. Gets a lot of reactions here. And really more important, I put a heavier weighting on the more recent tags of a trend line than what happened back, 8, 9 years ago. You can see here pretty well defined. So there's your level. You can replicate these trend lines, set a price alert. Again, it looks like we're poised to make a bullish crossover. The momentum indicator's turning up, but I went over in the video earlier today. Sometimes it appears that way, and you get a rejection when these two lines try to cross. Sometimes you even have a bullish cross, and then it fails. So it's not be all end all. It's just telling you right now, well, you can't go heavily short with the momentum indicators starting to roll up, but if they are rejected here, and especially if this trend line breaks on a weekly closing basis, and then all these other sectors, remember, if you're planning to short XLF, let's say, you want a high probability short entry. If you're planning to position short for weeks to months, you want to see the majority of sectors, and especially the support levels on the broad markets break down. I'm talking about the SPY, the NASDAQ 100, everything else. Because if XLF has a bearish chart pattern and maybe breaks down, but most of the other sectors hold support and the market rallies, it's going to drag the financials up with it, or at least give a short trade a lot of headwinds. So that's my tip, is to kind of keep your eye on all these charts together. And of course, that's what I do. If I notice any developments, I'll point them out. Let's see here. XLK, there's tech. Again, tech is, jump back to the daily chart, about a quarter of the S&P 500, and it's well over half of the NASDAQ 100. So what I see here, we have this trend line on this daily chart. I know it's very busy. Just focus on this lowermost trend line here. You pretty much had this price channel here, and you can see we've broken down, back tested. We're a little bit inside that channel, a little bit up above that trend line, or we were recently, and now look, we're back on it right now. So um, And as you can see here, as I go down to the daily chart, and I meant to cover that on more of those sectors, and I didn't point that out. This is what I'm looking at. A lot of those sectors on the daily, I showed you the weekly chart, I showed you the indicators, the PPO rolling, starting to turn up. But on the daily chart here, they're turning back down. And so obviously, the daily time frame is it's a faster time frame. I like to use the daily and the 60-minute charts to hone down my entries and exits. The weekly charts help paint the bigger picture, but my timing, when to enter, when to exit a trade, are based off these charts. So you can see RSI coming down off oversold levels. You can see the PPO starting to turn down, and you can see if we get any more downside next week, that'll put XLK back below that very well defined trend line. Again, it goes back. I have to go back all the way to it actually should have been extended out here. The early 2016 lows, like everything else I was covering recently. That's where a lot of these uptrends started. A couple more. XLRE, that's a Spiders ETF, but it hasn't been around long enough. So what I need to do there, I go to IYR, which was the first to market REIT ETF, to get a bigger picture. You can't go back as far in time on XLRE. So I don't have a very solid trend line here. I'll just tell you that. There are a lot of reactions recently here, and we broke down there. And this appears to be, and again, I took a weekly chart here and I'm zooming in. This looks sort of like flagging type action. It's a little big compared to the flag, relative to the flagpole right there. But either way, watch for a break of that, and that could definitely trigger some more downsides. That's IYR, XLU, although not a huge component of the S&P 500, about 3%. This chart looks ugly. You can see a very well-defined uptrend line off the 2009 lows, and you can see we broke down, we back tested for weeks, months actually, all year, 2018. We broke down early in the year, back tested, failed to get above there, and now boom, see this big red impulsive candle. I've had this trend line here. This is a nice little wedge. This to me looks like a bearish pennant or a bear flag, a little wedging type pattern. There's your flagpole, the impulsive move leading down to the formation. And now what you want to see on any bear flag or bearish pennant continuation pattern, you want to see an impulsive breakout, not just prices limping down through. And if so, you take the measured target as the distance of the flagpole added to the top of the flag there. And that would take us down here to this target about 45.55. Okay, and that's it for the sectors. And let's just wrap this up quickly by again looking at those top names. I already did it on the weekly chart, covered the weekly outlook. So let's just look now closely. Again, what I've done here is sorted the components of the S&P 500 by descending order of market cap. So we're starting out here. Apple, largest stock in there. I believe I covered Apple in the other. Yeah, I did. Of course, I covered Apple in the previous video today. But here it is. This is, these are showing you these divergent highs. Like I say, they don't always work, but they work much more often than not. They're all there. You can look at this. I've shared this chart so many times. Divergent high, and it shows you the corrections that followed each of those divergent highs. This one was 17%. Here was a divergent high here, and there was a correction. I haven't measured it out, but you can see it was close to, not as much as that one. And this high is what I call a yada, yet another divergent high. And you can see now barely, but you can see the PPO is still not taking out the previous highs. The RSI is also making lower highs, and if you really zoom in here, you can see how the line is sloping down, and you can see the PPO is curling over. So again, this is the point of this video, is to sort of hone in on the timing. Unless this market can turn around next week, next couple weeks and rally, even if we trade sideways for a few days, what happens during an uptrend, especially a sharp uptrend like we've had on the last few weeks, sideways trading has the effect of bringing these momentum indicators down, because that's momentum. If you're going up and all of a sudden you go sideways, the momentum is now no longer up, and that's going to turn these indicators down. So you don't have to move down just to get bearish crossovers here. You just have to trade sideways. But either way, let's see what happens. There it is, overbought, PPO rolling over. That's Apple, and I'll just run through the rest. Amazon, look at this, bearish crossover in play. Any more downside, and you'll have a bearish crossover on the PPO that will confirm this divergence right here at this point when we made a new high there. There's that, it's a clean little wedge. You can see a trend line off the low here, divergent high, and then boom. So what you want to look for, a sell signal would come on a break of this uptrend line. And of course, if that happens, you'd have that confirmed divergence there. A few more. We won't cover them all. Here's Alphabet. Go back. You have to go back away to see. This is, forget about every other line on this chart. I know it's busy. I didn't clean this chart up for the video, but there's an uptrend line off 2015, mid 2015. Very well defined. Lots of reactions as I come up this trend line. And so now I'll zoom back to this daily chart. And we've been dancing through it. We broke below it. Little stick save, came back up, but then fell back below it, went above it, and we're back below it. Um, this is a battle between bulls and bears. PPO is starting to turn down. So, like I said, in the next week or two here, if we start to see some heavy selling next week and we close in the next week or two with a big red candle down, it's gonna trigger a lot of sell signals. It's going to um, solidify a lot of the bearish technicals that I'm seeing in the charts right now. Likewise, if we can rally and put in some big green candles, it will have some stick saves. We'll have some stocks that were just at support or just below support that it would have been able to regain those levels, undo some of these bearish technicals, point these indicators back up, maybe burn through some of the divergences, etc. Microsoft, here's a wedging type pattern. We had a divergent high there. We had a pretty sharp correction. We have another divergent high. You can see these indicators lagging. When I zoom in, I see the PPO curling down, poised to make a bearish crossover on any more downside next week. Hasn't done it yet, but the potential is there. And then you have, of course, this well-defined uptrend line right here, this white uptrend line. That would be a sell signal, as would a break below that 87.43 level. So that's it. Here's Facebook. A nice little rally here. We had a divergent high here back at the time. I pointed that out, and I had this, question mark drop. This was a, potential target. How far are we going to drop? We fell a little shy of that target. Nice kickback rally, but you can see here we're still below trend. There was a pretty well-defined trend line. We're overbought, and the PPO is starting to curl over. And as you can see, again, same story. I'm looking at these momentum indicators. They're all turning down right now in the daily time frame. And certainly if I move down to the 60-minute time frame, you'll see that as well. But I have to keep this video relatively brief. Told you already, the financials are one of the more ugly looking sectors right now, in my opinion, and they're also one of the top weighted components of the S&P 500. Here's Berkshire, trend indicator of PPOs below the zero line and has been since it crossed back here, and it's also below trend. We just recently broke below trend, a little kickback rally that stalled both at this 264 price resistance as well as a back test of the trend line. So there's not one positive spin I can give this chart right now. I mean, the stock is not far off all-time highs, so don't get me wrong, but from just a pure, if you put everything aside, your biases, where you think this is going, this to me looks like a nice shorting op. You had a breakdown, a back test that failed both at the trend line as well as price resistance. So anything could happen next week or in the next few weeks, but that is my current scenario for Berkshire. And if Berkshire goes down, that's one of the largest financials. JP Morgan flirting with uptrend line support as well. Again, I went over these in the weekly charts. PPO starting to roll over, RSI heading down. So again, this is just sort of the same video, just zooming down to these shorter term time frames. I told you I didn't have a strong opinion on XOM, but I did go over the energy sector as a whole. And XOM, by the way, XOM and CVX make up, I think it's 40% of XLE. Almost half of the XLE, that one ETF, is made up of just two stocks, ExxonMobil and Chevron Texaco. But there are other stocks within the energy sector, and that's why XOP is one of the short trade ideas right now, or DRIP, actually, we went with either one. BAC, Bank America, again, here's another financial market leading bank. PPO starting to roll down. The story on this, we had an uptrend line right here. Broke down. We've been in this sideways trading range to kind of zoom in to see what's happened and what might happen. This is what's going on right now. We're in this sideways trading range since the breakdown. Pretty well defined support level. We've stalled at every attempt to get back above this 33.10 level since we've been in that range, and we're rolling off that level now. So this is trading 101. I can't promise you which way this is going to break. I highly suspect it'll break to the downside, and if it does, at Bank of America's headed down here to about the $26 level. But what I can tell you is it's objective. When you see a trading range like this, you sell at the highs, whether you're long, whether you bought at the bottom, you either sell your position, you're long there, or you short. for a move back down there. You can try to buy if you're bullish. You try to buy. This would be your next objective buy point, a move back down right there about 29 or so, or a, a convincing breakout above the top of that range. That would be the next. So those are your two objective buy points. That's what I can tell you. I can tell you where levels, what triggers an objective buy or sell signal. There's no guarantee to any trade, but that's what stops are for. So, for example, if you short a bounce up to 3110 with a stop somewhat above, maybe 3150, wherever you want to put it, um, your downside loss potential is minimal compared to the gain potential, and that's what trading's all about, is finding those objective entries so that you can place a relatively tight stop relative to your profit target. At least a 3-to-1 better risk return. Risk $1 of loss for three or more units of profit. We're going to wrap it up here. I just hit the 30-minute mark. Oh no, one more. Sorry guys, because this is again a video for members of the site. So this one I'm thinking about adding as a trade idea. I really like it. Visa. You can see here PPO is starting to curl over, about to make a bearish cross on any more downside. Negative divergence here on this daily time frame. There's your trend line right there. And when I look at it on the weekly chart too, I see a stock that here we go. This goes back 10 years, and what I've done here is shown every divergent high. You can see the negative divergence down below, and I've marked what the drops. This is a 35% drop following that divergent high. Next divergent high led to a 17.3% drop. I should have extended that trend line. Somehow I missed that, but that's the divergence line right there. I can't move these once I draw them on this screen grab software. We had a divergent high right here. Actually, I should add a second little line there. Doing a horrible job of that. Either way, there was a peak right there, caught it on the RSI. So that was divergent high number one. This is what I refer to as consecutive divergent highs. So you had a divergent high that led to a 22% drop. The stock kicked back up, made a second, but still divergent high. It was an extension of those previous divergence, another 18.4% drop. I see no reason why this divergence won't play out the same. But again, divergence is only an indicator that a potential trend change is likely coming. Your sell signal will come obviously on a break of the trend line there. And that's, of course, again, how we can zero down, look at the daily charts, and really try to hone in on an entry here. 60-minute chart's not very clear to me, but I just want to let you know this one's on watch for a potential trade setup, because I can see if this trend line breaks, that's a minimum target, more of a real bump in the road, actually. I think we have a little reaction there and then come on down here to this target zone. And ultimately, I think down to about 83, 82 is where I think this one heads. And it might take, it would likely take months to get there, but it's worth it. It's about a 34% drop from where we're at right now. All right, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. I know these are long videos today, but I see a lot in the charts that I think are worth covering. And as a trader or investor, we make most of our money, especially an active trader. You get those opportunities just a few times a year where there's big moves in the market, and the rest of the time, I find it best to keep things light, sit on your hands, and wait for the market to set up for that next big move, whether it's bullish or bearish. All right, have a great weekend, guys.